Ukraine flips off Russian demands and the stock markets drop quite a lot. Oh my, look at this big red candle. What's going on in the markets? Let's talk about that. Welcome to myfinancesteacher.org. As I mentioned to the members and to the viewers on YouTube, I was expecting that the general stock markets were going to come down a little bit over the next perhaps 1 or 2 weeks, possibly into that FOMC meeting. And once that FOMC meeting is out of the way, I think that's when the stock markets will finally start to trend a little bit higher into that new intermediate cycle. And so far, I still don't really expect the S&P 500 to make a new low versus that low on the 24th of February. Although we are coming pretty close to that previous low. Let's see what happens over the next few days. But in the intermediate term, I am pretty certain that the markets are about to rally out of this intermediate cycle low, which either happened in late February or about to happen just over the next few days. And in either case, we see that the 14-day RSI is recovering over the last few weeks. Although there is a lot of uncertainty geopolitically, we see a lot of red candles lately. There is clearly a lot of fear on the market. But as I've tried to remind you many times on this channel, it is generally a good idea to start building your long positions when everyone is fearful. And looking at this fear and greed index, the CNN Fear and Greed Index is at the lowest levels all the way since that pandemic crash in early 2020. So in the intermediate term, again, anywhere around here is going to be a relatively attractive buy, in my opinion. Of course, let me just remind you that nobody knows the future, and I'm simply trying to share my opinion on what I think is the most likely scenario. So that most likely scenario is perhaps opening a little higher on Tuesday morning, perhaps a continued decline for another few days into that FOMC meeting, that's mid-March. And after that, I think the stock markets will be ready to rally a little bit, perhaps creating some sort of a inverse head and shoulders formation with this tilted neckline. And breaking above this downtrend line would perhaps confirm that the intermediate cycle low is behind us and the markets are rallying into the new intermediate cycle. A quick look again at the smart money, dumb money confidence. We looked at this in the previous video. We see that the smart money is at the highest confidence levels since that pandemic low, and the dumb money has recently been at the lowest confidence level again since that pandemic low. Usually you do want to follow the smart money, that's the blue line over here, and we don't really want to follow the dumb money. So dumb money being quite scared and smart money being quite confident is a relatively good sign in the intermediate term. So that's the intermediate term outlook. But as I've mentioned to the members at myfinancesteacher.org, I would want to be quite agile with taking any profits, because in the longer term, there are some signs that caution is perhaps advisable in the longer term. And the main reason for that is relatively high oil price. Looking at previous several recessions over here, for example, starting in early 1990s, 3 of the previous recessions were actually preceded by more than a doubling in oil price, with a bit of an exception of the previous recession of this CV-19, of course, a special case of a bit of a pandemic there. So let's have a look at each of those cases. Early 1990s, zoom in on this first doubling in price. Oil price gained over 130% in just 3 or 4 months over here. And that was just before that recession in early 90s. Next one, the dot-com bubble in early 2000s. The recession taking place in 2001. Again, what happened to oil price is that it more than doubled. It actually tripled just a couple of years prior to that. And if you might argue that tripling in 2 years rather than doubling in around 4 months is more of a gradual move, you might actually shorten this duration to something over a year, and you still have doubling of oil price within that period preceding that recession. The next recession, the global financial crisis, again, we see oil price nearly tripling with gains of nearly 190% just before that global financial crisis in 2008-2009. Next, a bit of an exception with the pandemic, of course. Oil price only gained around 80% around a year before that. But if you count from early 2016, which is actually quite a while, that's in over 2 years, that's nearly in 3 years, oil price gained 162%. So that's well over doubling in price. But perhaps the period is a bit too long, making this gain a little bit more of a gradual thing. So perhaps a pandemic is a bit of an exception here. But what's going on right now is, even if you don't count this oil price somewhere around $12 at the bottom on the spot, even if you count the oil price gains after a bit of a correction into late 2020, you still have around 250% gains in oil price since late 2020, since the beginning of 2021. That's a multiple of 2.5x. That is a significant gain, which is, again, unfortunately, likely to lead to some recession. After all, in some of the recent testimony from Jerome Powell, we heard that he mentioned that every $10 higher oil is likely to translate into an additional 0.2% inflation. And counting over the last year, since early 2021, when oil price was, say, call it $30 and say recent price around $120, that's an additional $90. That's an additional 9 times the $10 times 0.2% each. That gives you an additional nearly 2% inflation. So things aren't going to be that easy with consumer confidence, and perhaps a bit of a recession fear might actually be grounded. Again, in the longer term, another sign that agrees with this crude oil doubling indicator is a negative yield curve. The 10-year to 2-year yield curve, whenever it drops into negative below zero over here, we do see a bit of a recession. That happened again in early 90s. The yield curve negative before that for about a year. In early 2000s, the dot-com bubble, the yield curve negative before that for about a year, and about a year of a negative yield curve before the global financial crisis. And in this case, the pandemic low wasn't actually much of an exception. Again, we saw a dip, a short-term dip into that negative yield curve before that significant pandemic drop. And more recently, the yield curve has dropped quite significantly. It hasn't really dipped into negative levels yet, but if the Fed starts tightening on the short end, and if the long end doesn't really react with too much uncertainty on the markets, then we might actually see this yield curve dropping into negative territory over the next several months. That will simply be another cautionary sign in the longer term. In the longer term, perhaps one should be somewhat careful with the long positions in the general stock market. As I mentioned, in the intermediate term, I still do expect a bit of a bounce from the intermediate cycle low, perhaps over the next couple of months. But what happens after that is maybe a bit of a consolidation of the gains that the general stock market has enjoyed over the last couple of years. Since early 2020, the S&P 500 has already more than doubled. A lot of the charts do look similar from that 2020 lows. And I often like to look at the example of copper. After copper has more than doubled in price since the pandemic low, it has been in a bit of a consolidation for quite a while, which, by the way, it's breaking out of right now. So perhaps something similar is likely to happen to the general stock market as well. A bit of a consolidation without much of the significant new highs for the ongoing intermediate cycle. And whether a recession hits after that or not, that does remain to be seen, but a bit of a caution over here with significantly more expensive oil is quite understandable. By the way, to the members at myfinancesteacher.org, I have already mentioned that we perhaps don't really want to be too greedy with our take profit positions once this bounce out of the intermediate cycle low takes place. So for more details, feel free to join us at myfinancesteacher.org. As you see, I do post quite regularly on a range of assets, including the general stock market, cryptos, precious metals, energy, and other commodities. Have a nice day. Bye-bye.